Are we 8:30? I think we are. 8:30 Mountain Time, 10:30 Eastern. Welcome, everybody. Let's get rid of that banner. Let's get rid of this music. Let's get on with the show. What I want to know is how my friend Ion was able to comment on YouTube before I even started the live stream. That leads me to believe that I have an internal control problem, but welcome. Welcome if you're listening to the show. You know what I forgot to discuss yesterday? I should have talked. I'm not going to talk about it today, but I'm disappointed with myself. When I talked about my favorite stories, and we talked about the Turkish shooter, we talked about RFK Jr. and the bear. Well, I missed entirely Maduro. Is that his name? The president of Venezuela? Maduro challenging Elon Musk to a cage match and Musk accepting. This is all over Twitter. I love this story. Musk is the best. And there's public speeches in Venezuela of Maduro, whatever he's saying in his language, challenging Musk to a cage match. Cracks me up. So many of you asking, hey, Scott, you're wondering to yourself, maybe you're not asking me, Scott, how is it that you happen to, oh, wait, did you know, by the way, that yesterday was episode 250 of this podcast? I didn't know that. Episode 250 yesterday, we're 251 today. This is years in the making, do a show every week, and then, take a few months off and start up again and this and that. But I'm told, the reason I know this is I'm told that less than 1% of podcasts get to this stage. So we may add some value, we may suck, but at least we're persistent. We know that. Episode 251 today. So many of you ask or think to yourself, hey, Scott, how do you do that? How do you prepare for all these podcasts? And particularly if you're doing a morning live stream, you need to prepare a little bit, presumably, so you have something to talk about. And that's true. That's true. I take some notes during the day, try to plan things out a little bit as to what I might want to talk about tomorrow. I try to keep the preparation down to a minimum, as you can tell. maybe an hour makes sense for me, an hour and 20 minutes in total. And most of it is the night before. Otherwise, I'm just panicked and screwed in the morning, and I end up wearing a baseball cap because I wake up late and I'm running around trying to make sure I have everything ready. And so most of it I do the night before, and I bullet point out sort of my notes that I might want to talk about and how that's going to work. And my problem is that by morning, after I've had a good night's sleep, I have a different attitude about something. Right. And usually the way it works is at night when I'm working, I'm grumpy, fuck the world sort of attitude. And I have a pretty negative view and outlook on life. And in the morning, I'm full of love and happiness and optimism. And so my take on the story changes entirely. Well, as an example of that, I was all prepared this morning to gloat, to pat myself on the back, to be happy in the misery of others. That's what I was going to do. Let me give you some background on that. Hey, Mummy Hack X3 on Instagram. I have to flip to a different tab on my computer to see the Instagram who's listening and to see if there's any comments there. So just a little shout out. And Ion, if you're still listening, good to have you join us. By the way, Ion is writing us some music for this podcast, so I can't wait to get that in. I think I can announce that. I hope I'm not being premature. Anyways, I was willing to gloat and be happy in someone else's misery. So I don't know, probably 5 years ago, I started working for a company in Canada as a consultant. And this company was in significant financial distress. They were in manufacturing and in automotive parts. I think this is public information at this point, so I don't need to hide the details. In Quebec, automotive parts manufacturing, and they were losing money. They were losing a significant amount of money, and their balance sheet was upside down. In other words, I always tell you in turnarounds and when you're dealing with troubled businesses that you you need to look at two different things. One is operational. Am I making money or losing money? The other is my balance sheet. Do I owe too much debt? And am I making enough money to pay off that debt in a reasonable time frame? And if I'm not, I need to restructure. And if I need to restructure, do I have enough cash flow in between sort of getting from the restructuring to where I need to be profitable, right? Those are the things that you looked at. I've talked about that many times on this show. Well, this company was upside down on its balance sheet and it was losing money. It was losing money predominantly through bad management, top heavy, sucking a bunch of cash out, related party expenses, family working everywhere, was the analysis. And on the balance sheet side, they owed the bank not too much money, but one of Canada's top banks was owed some money, and they were first secured. And the assets of the company said that they may not get out in whole. And then below them was what they call sub debt, so a different layer of debt, which was a lot of money, 13 million, as I recall, for a mid-sized small business. So a bunch of money, and if the company was liquidated, they were not going to get any money out of that, or very little. And then, of course, the unsecureds, all the suppliers that had financed the business and not been paid and been screwed in some way. And so that was sort of the look of the balance sheet, and it seemed like it was relatively safe and made sense to start making money, which is the first test. If you can't make money, there's nothing you can do with a business. But the balance sheet needed to be restructured. And to restructure that balance sheet, the old bank needed out, so we needed a new bank. So, without getting too deep into it, we can talk about this story more on future episodes, but we needed a financing. And the financing was part of my role to try to help them find a new bank, which I did. And we got a committed financing in the form of what's called a DIP loan, a debtor in possession loan. And this financing was going to come in and was going to take out the old bank in whole. And I had made proposals to the sub-debt people, to the people that were behind the bank, to how we might pay them out. And those negotiations were not going well. And at the end of the day, you have to go to court for a DIP loan, and the judge has to say yes. And the judge did not say yes. The judge said no, which is very unusual. And I still, to this day, I'm not sure what the legal argument for that was. But the bottom line is, I'm sure there was some nuance that I missed in that. But the bottom line is the DIP was rejected, the financing was rejected, and so the company did not have the financing it needed, and the old bank was not going to get out, which was the entire point of the exercise. And so the company was going to go into receivership. That's sort of the next plan on this. So the company goes into receivership, and you just start selling off the assets is the idea. And you do that through a formal process. But before that happens, what the managers were doing, the owners were doing, and these people were unreputable, they hadn't been paying people, they were sucking up money for themselves. Their financial statements were sketchy at best. We're going to talk about financial statements more today, but they were, the financial statements were done not necessarily for reality, but to get a bunch of financing in the door, which is what had happened. And I'm cleaning that up to this day, by the way. And so there was a lot of things that were going on with these owners that were not above board. And what I caught them doing, I believe, was moving assets from one location to another location in Europe, where they had another similar manufacturing plant. And so basically they were ripping assets off and moving them. And we've got some evidence of that I wasn't happy about. And so, I don't want to be associated with that sort of stuff. And so I resigned, and the shit hit the fan. And by that, I mean, the bank, they wanted, obviously the company, the owners wanted to go on with the financing to buy the business out of the receivership. And the bank didn't want to finance them to take it out of the receivership, because I personally was no longer involved with the file, and me being involved with the file gave the bank a bunch of comfort. And so it all fell apart. And then these owners started going around my community and bad mouthing me that I'd put them in this position and telling a bunch of lies about me in hopes that that would help them to get some financing so they could buy their business out of receivership. So it was just a mess. I was unhappy. I was very angry with them for telling lies, for moving assets around. And Ion says, "Hey, super excited to be part of it, Scott." So that's the music coming in. Yeah, I'm excited for that too, Ion. Hopefully, we get that going in the next week or so. And so, anyways, everybody's angry with everybody. They're bad mouthing me, and now I hate these guys, right? Even though they're deep down, they're good people who are just doing their best to survive for their family. Long story short, the receiver starts to sell the business. I end up putting a bid in with that same bank. I win, and we buy the company, and we now have the Canadian operations, and they have their UK operations. Now what happens? Now we have staff harassments. So these guys through surrogates or directly are harassing my staff. They're threatening them. There's break-in attempts at the building. We've caught them on security cams. They're harassing customers. This is years ago now, and and they continue on. They continue on to really try to just damage our business, not for their own good, but just to damage our business. So I have a significant distaste for these people, and I don't trust them as far as I can throw them. And what I learned yesterday is that their operations that they held in the UK have now gone bankrupt and they are out of business. And so, as I said at the beginning of this, I came on here prepared to gloat and be happy at someone else's misery. But when I woke up this morning, I'm no longer in that mood. That was last night's mood, and I need to be a better man than that because, it's hard. It's really hard on employees. It's hard on customers. It's hard on investors. It's just hard on every. You have learned only to let people work and not get paid. I'm not sure what that means. And so it's hard to put people in that situation. And really what I want to do is just wish everybody love and success, even these enemies that have blown up. I want to wish them love and success, and their family and their employees. And by the way, who the hell am I to talk? I don't want to work in somebody else's misery. In 22, 23, I was sick. I was sick for like 9 months, and we had some really significant problems with businesses as a result. We had our own management team that put us in a terrible, terrible situation. And so I'm not one to talk either. Like everybody in business gets themselves in trouble. For me, I was off sick for quite a while, and those that know me know the story. But at the end of well, really early 24, I've been back. I've been strong, and we're rebuilding everything. And so, anyways, here's the point. The point is, I just want to wish everybody love and success. I'm ashamed that I wanted to gloat and revel in somebody else's failure for a little while. And there's my full disclosure for you. So yesterday I did a free coaching session. A free coaching session. So what is that? So we do this virtually. We do it over Zoom, and we did it for 30 minutes. And when I have some extra time, which is not awesome, when I have some extra time, I've offered free sessions, and my compensation for this is that I get to record it and put it out to you so that you can learn as well for your business, and ride along on a journey with someone else who, in this case, is a startup, and they're looking to do some coaching. And so we're going to have that out maybe even today, but certainly by tomorrow on all the channels on the Winning Momentum podcast. And the specific ask of this client for coaching is to review his business plan for a startup and to tell him what deficiencies there were in the business plan so that he could do financing. So it was a great 30 minutes. I think the content is fantastic. I think it'll be helpful to a lot of people. And here's some of the things that we discussed. We discussed business plan is not a deck. Okay. So there's a difference between a business plan, which should be an internal document for you, and you are never going to get your business plan right. It's not something that, let me put it this way. The value of a plan is the exercise of preparing the plan. Okay, because it forces you to ask yourself questions. How does this work? How does that work? How does this relate to that? If I do something like this, is it going to change my profitability? Is it going to change my cash flow? The idea of preparing a business plan, diving into your target market. What are the key success factors? How do you deliver your solution relative to the competition? Your 4Ps, your product, place, distribution, product, place, price. Yeah, product, price, place, promotion. That was my fourth one, right? So all of these things, the value of the plan is it forces you to think. It's not that you're going to meet your plan. Nobody's business plan ever survives first contact with the market, right? But you go through the process and it helps your thinking and you understand your business better and you develop the strategy. Here's what we're going to do. Here's the problem we're trying to solve. Here's how we're going about it. Well, and by the way, your business plan should be largely numeric. We do ours in the form of a 12-month rolling monthly financial model, which will go out 3 years to 5 years. It's very comprehensive. It talks about all the line items on a financial statement, and it has the accompanying notes that go along with that. So we document the assumptions that drive that model, and that is our business plan. And then we update it as actual comes in every month. We update it to amend that plan as we need to. Well, that's not a deck. A deck or a pitch plan is intended to help you raise capital, and you need to address that directly. And so we talk about that and the difference. So we talk about the what I call the RIOS, RIOS approach to thinking about investment, which is if you're an investor, if we switch hats, what is it that you need to hear as an investor? What you need to understand as an investor? Well, you need to understand your return. How much? Why am I listening to you? I don't really care what your business is. I don't care what you're trying to solve as an investor. What I care about is my return on investment, right? So what is my return? That's the R in the RIOS. What is the I? The I is, how do I get into this deal? What are you trying to sell me? Are you trying to sell me debt? Are you trying to sell me equity? If so, what type of debt? What type of equity? And then the O in this, so it's RIOS, is how do I get out? If it's debt, when are you going to pay me back? Right? How do I know your cash flows support your ability to pay me back? Does it just come out of internal cash flows? Does it come out because you sold the company? Does it come out because you're going to refinance with somebody else? What are the risks? What are the risks of those things happening at all? If it's equity, how are you going to, how do you pay me back with equity? Right? Are you going to sell? Is the plan here to build the business from NewCo to sale in 5 years or 7 years? And if so, what is your valuation trigger when you're trying to sell? How much do we think we'll be able to sell for? Who are the likely buyers? And what are the risks of that happening? And by the way, what if you fail? What happens then? What happens to me? Do I get out first, or do I have to share equally with you? Or are you trying to cram me down so you get out first? Right? So R, what is the return? How do I get in? How do I get out? And the S is, what is the security in between? Right? So if I'm debt, is it secured debt? If it's secured debt, what are the assets? If it's unsecured debt, what's the balance sheet going to look like? And how do I know that I have some control over this when things are going sideways, that I could enforce some decisions? And if it's equity, similar thing. What's the shareholders agreement look like? What's the board look like? How do I know that you're not taking my money and just paying yourself with that? And if you are, what can I do about it? Right. So we talk about how to, and that all of that needs to be in your pitch deck in a certain way. You need to be able to convince, you need to be able for sure pitch benevolence. We're trying to do something for a good thing. I don't think we're gonna have time today, but I'll talk to you about this idea of pitching benevolence over competence. You can see that on past episodes of Martinis with Scott. That's one of, in fact, the most popular episodes that we ever did on the Martinis with Scott channel on YouTube. You can look that up, but maybe I'll try and work that into tomorrow's agenda, that story for you. But you want to pitch benevolence for sure in your pitch deck. You know, here's the good that we're trying to do in the world, but the hard numbers of this are, what return do I get as an investor? What kind of product am I buying? In other words, how do I get into this deal? And then how do I get my money back? How do I get out? And how do I stay safe in between? It's really that simple. So a business plan and a pitch deck are different animals. We talk in the coaching session about partnerships. We have a situation you'll learn when you listen to this, if you do that, where you've got 3 partners and they're all starting up this business and they're equal partners, yet one of them is putting his house up as security and the other 2 are not because they don't want to, but just they're not in a position where they can do that. So I explained to this person that often, like every day, every week, I see troubled businesses come to me in exactly that situation. And this whole idea of kumbaya and we're all equal and things are going to grow and it's all great is awesome. It's awesome when things are going well. It turns to shit when things are going bad. That's the real problem. And you know, you need to get some sort of compensation so that you can get your money back ahead of the others, because you're the ones that put the money in, put your house on the line. If things go bad, and everything goes bad, everything goes bad. I started off this show talking about somebody else's misfortune and me having a short-term glee with that misfortune. But then I've also disclosed to you that I've had my own misfortune when I was ill. And, you know, everybody goes through a bad time. The question is, what do you do about it? And if you put yourself in the position where you're the only one with your house on the line and your partners do not, it's not going to end well. There's a real risk that it's not going to end well. And so we talk about this idea of different hats. Okay. I don't mean a Martinis with Scott hat. I mean, when entrepreneurs start a business, they often just think of everything being one commingled blob of execution. Whereas in reality, the entrepreneur is a shareholder. The entrepreneur is a director. The entrepreneur is an executive. The entrepreneur is potentially a lender, putting your house on the line. The entrepreneur is a partner. The entrepreneur has all these different hats, roles, positions around this corporation, but they are not the corporation. The corporation is a separate, distinct entity. That's the way that you need to think about it, and it's also true in law, right? But you have all of these hats, and every one of these positions has different rights and different obligations. And so if you're putting your house on the line, you are an investor. How are you getting in? How are you getting out? What is your security? It's a different hat from being a shareholder. Okay. If you're getting equal share, like one of his partners is, because you provide value on the sales side or whatever, are you being double paid? In other words, do you get a third of the company for that skill set of selling, plus you get a economic pay package with upside because you're selling? Is that the way this is going to work? So you need to separate out those hats. So all of this and more, I'm running out of time, is covered in this coaching session. And so that's pretty cool. So wait for, I think this is the first time we've done a free coaching session that is available to you in its entirety, and will be up in the channels maybe later today or tomorrow, certainly this week. Financial literacy for business. Many of you know I do a financial literacy for business series, And last week we didn't do it because I was on holidays. We didn't have a live stream, but the week before we did a balance sheet. And I thought in truth that I did a lousy job at that. Excuse me. I did not a great job at that. And also we forgot to cut it out and post it separately on the thescottsinclair.com and other channels. Mr. Steven says he looks forward to watching the coaching session. Cool. Thank you for that. It's going to be good. So anyways, I'm going to redo that, but I'm going to do it a little more comprehensive because the balance sheet was just boring, and then we'll cut it out separately and put it on the newsletter as we typically do. So you ready? Here we go. Financial literacy for business. What are financial statements? When you have financial statements, they are typically, if you have externally prepared financial statements, I want you to think about 4 separate things. One is a balance sheet. One is an income statement. One is a cash flow statement. Those are the 3 statements. And then you have the notes at the end of those statements. Let's talk about those quickly. So a balance sheet is a listing of, by category, of everything that you own and everything that you owe. Everything that you own, called an asset. Everything that you owe, called a liability. And your assets are typically on the first page, or if it's a 2-column, it's on the left side and the liabilities on the right side. But the assets are broken into short-term and long-term assets. So short-term assets are typically assets that you will get the economic benefit of in the next, say, 12 months. That's the idea. So cash is something you could spend today. You don't need to wait 12 months. That would be a short-term asset. Accounts receivable, so people that owe you money. Inventory, if you can turn that and get your money out of it in 12 months or less. Prepaid expenses, those are examples of short-term assets. Long-term assets are things that you don't get your economic benefit out of it in full in the next 12 months. So think manufacturing equipment, real estate, capital leases like a photocopier or something that you end up owning. And so those would be examples of long-term assets. And then what a balance sheet does is it adds up those assets into short-term, takes your short-term plus your long-term, and those are your total assets. On the other side, the next page or the other side of the column, you have your liabilities. This is the amount of money you owe. And again, exact same thing. Short-term, long-term. Short-term is stuff you have to pay probably in the next year, and long-term is stuff that you have to pay beyond the next year. And right, so your short-term would be accounts payable, your bank, the current portion of long-term debt. So if you have a 5-year term loan, well, you take that first year and you put it in current, and then years 2, 3, 4, 5 stay in long-term, right? And long-term debt is everything that you don't have to pay in 1 year. And again, you add up your short-term and your long-term liabilities, and you come up with total liabilities. The third section of a balance sheet is equity. And equity is, this comes to the heart of why this balance sheet is called a balance sheet. It balances, it's a formula. Assets minus liabilities equals equity. And the equity is what the shareholders own, because you have your assets is what the corporation owns. And then you have your liabilities is what the corporation owes. So the one is applied to the other, and what's left over goes to your equity. It's owned by the shareholders. 1 second, please. Sorry, dealing with allergies still. And so your equity is further broken down into a bunch of different things, but the most important are common shares. So how much money have the shareholders put in by buying shares out of the treasury of the corporation? And retained earnings. In other words, last year we made $100,000 and we didn't take it out of the business. And so now there's an extra $100,000 sitting there as an asset in some shape or form, and that becomes equity of the business. So that's a balance sheet. An income statement is an entirely different statement, and this is your profit and loss. It has revenue, and revenue is something, you know, you've sold something or delivered a service. It's something that has already happened. It's real. And it means that somebody has either paid you or they owe you the money, and you have a reasonable chance of collection. And if all of that is true, then you can book that as revenue. Deducted from revenue is your cost of goods sold, which is everything in accounting that relates to selling and generating that revenue. So you think direct materials. If I sell these glasses for $10 and I paid $5 for them, my revenue would be $10. My cost of goods sold would be $5, and I would have a gross margin, revenue minus cost of goods sold, of $5, 10 minus 5 in that case. Your direct labor can go into cost of goods sold if you're manufacturing. If I actually had a bunch of elves making these glasses and I need to pay them, then that would go into there as direct labor, direct overhead if I have a manufacturing plant. So all of these things go into cost of goods sold, and then revenue minus your cost of goods sold is your margin, your gross margin. Don't confuse that with contribution margin, which we talk about on this show as being the most important thing that you can focus on for making more money. That's not what this margin is. This is gross margin. And from that, you deduct all the other expenses that did not go into your cost of goods sold. These are your operating expenses. They would include overhead salaries, insurance, marketing expenses, interest, depreciation, all this sort of stuff. And you're netting out with earnings before tax. Deduct your tax, your income tax, and you end up with net income. That is an income statement. And really, what an income statement is doing is it's explaining the change of the balance sheet today to the balance sheet tomorrow. In between, what happened? Well, we had these operations. So the balance sheet is like a snapshot of where you are at a given point in time. And an income statement is what happened over a period of time. Does that make sense? And then your third statement is a cash flow statement. I wouldn't even worry about this. This back in the day was a different statement called the statement of changes in financial position, and that was super useful for financial analysts like myself. And a cash flow statement is sort of that, but slightly different. And basically what it does is says, okay, you used to have this much cash, now you have that much cash. Here's the places you generated and spent cash. That's what it is over the period of time. And it's not very useful for anybody, I don't think, unless you have a specific question and it happens to be on that statement. And then the fourth thing we talked about was the notes. Well, the notes is a long prepared list of sort of some comments on each line item, like bank debt. It may give you disclosure of the type of debt that is there. So if you're analyzing a company, if you're an investor and you're trying to look at pubcos, well, you need to spend a lot of time reading those notes to understand that detail. And that's what externally prepared financial statements are. What the hell is externally prepared financial statements? That means the accountant did it. And the accountant did it. And they're going to do it in one of three ways called the levels of assurance. They could audit, and an audit opinion means that they've reviewed everything and they found nothing that looks materially wrong to them. Okay, materially doesn't mean like it's every dollar, but material to the company or to this set of financial statements. So they could audit it, they could review it, and review level of assurance is a negative assurance. And so what that says is, hey, we took a look at this, nothing popped up to us that seems wrong, right? So it's not like we looked at everything and everything's right. That's the audit. The review engagement is, we took a look, nothing seemed off base to us. Okay, that's a reviewed, or they can compile the statements, which is really a word formatting exercise. You as a company give them the numbers and they put it into something that looks like a financial statement that you could have done yourself. And they might ask some basic questions if things don't make any sense. But their notice to reader, their statement that goes to the front of the statements is like, hey, man, we didn't do any work on this. This is all the company's information. And so that's what a compiled financial statement is from a external accountant. Audit, review, compile. You need in your business some level of quality financial statements. Your financial statements are your report card. They are your report card. And if you don't have good, up-to-date financial statements that are true, that are accurate, I promise you 100% it will come home to roost and you will fail. Okay. Just like the company that I talked about at the beginning of this live stream, that was one of their main failings is they were messing around with their financial statements to get more financing, and it has caused them problems. It has caused them problems. All right, those are my prepared remarks. Anything else in the comments I need to address? I don't think so. That's it. Hey, we're doing these live streams 8 a.m. Mountain, Monday to Friday, every day. Thank you for joining me. And yeah, that's it. Talk to you tomorrow.